I love companies. Of all the different structures that we have available in Australia, they are by far and away my favourite. Today, I'm going to try and make you love them as much as I do. So what is a company? To understand what a company or a corporate form is means understanding two key concepts. Firstly, that it's its own separate legal entity, and as a separate legal entity, it's afforded many of the rights that an individual has. It can enter contracts, take out loans, be sued, sue someone, own assets, pay taxes, and so on. It can live forever without being closed down. It is usually created by one or a group of people exchanging funds, normally cash, in exchange for an ownership percentage in the company, i.e. a shareholding. Shareholders are usually limited in terms of their liability to the amount that they've actually invested. This is a concept known as limited liability, and I will go into a little bit more detail about this later on. The second concept we really need to understand is how the corporate form came into being in the first place. This does involve a little bit of a history lesson. A company or a corporate form can actually trace its roots back through centuries. However, it really began to take hold in the 1600s in the shipping industry as a way of managing liability and risk as a result of taking voyage around the world. Probably one of the most famous companies that crop up in many a pirate movie is the East India Trading Company, which relied on the corporate form to move its ships and cargoes around the world, managing investment and risk at the same time. Fast forward several hundred years, and a company or a corporate form has become one of the most popular business structures around the world because of this concept of limited liability. The concept of liability has also been around for generations and has its roots in Italy in, again, the shipping industry. It came about as part of an economic arrangement whereby a passive partner would provide the investment funds needed for a managing partner to sail vessels. At the completion of the voyage, the profit would be split between the partners on a pre-arranged basis. This allowed the passive partner to limit their liability to only the amount that they had invested, and the managing partner would take on the risk of moving the cargo and the vessel. As time went on, the number of people investing grew. When it comes to the modern day, this concept of limited liability is an integral part of how companies function. Indeed, it's one of their key advantages. Imagine you are a mining company or a company undertaking research into a new product. This concept of limited liability is really attractive to investors because it allows them to quantify any loss they may make by investing in your project. In most cases, it protects their assets so they can relax knowing that they aren't risking the family home by making this investment. In Australia, companies are governed by the Australian Securities and Investment Commission, better known as ASIC. ASIC administer and apply the Corporations Act, which, for lack of a better analogy, is the law which governs how companies behave. Failure to adhere to the law can result in punishment, the worst of which being the forced wind-up or closure of the company. There are also penalties for directors in there as well in this instance, but that's a subject for another day. Now we all understand the two key concepts of what a company is and how it comes into being. We can have a look at their pros and cons. For me personally, the two key concepts of limited liability and the separate legal entity are two massive pros. This is because mentally I find it easy to imagine a company as a separate individual and treat it as such. This makes running my business much easier because some of the more complex things I need to be understanding are made much easier by imagining the business as a completely separate person, albeit one without a physical form. I find explaining to clients that the business is not an extension of themselves much easier when we are explaining to them that it is a separate legal entity. Here in Australia, when you set up a company, you are actually given a big file with all the documents in it that are needed to run the company. If you liken this to the brain of the company, then everything begins to fall into place and it makes the documentation requirements that much easier to understand as well. Limited liability is a great bonus as well because it means that as a small business owner especially, you can actually separate your personal assets from the business, and it means that if something goes wrong, you are unlikely to be left homeless. Taking out a loan in the business and providing a direct guarantee can actually render the limited liability side of your business completely null and void. So it's just something to be aware of, but again, a topic for another day. This concept of limited liability is a massive bonus over other business structures such as partnerships. Many professional practices, especially those in the medical, legal, accounting, veterinary spaces, are set up as partnerships, and this is because of their ability to distribute profits. However, in the event that one partner acts inappropriately, all other partners are jointly and severally liable, both on a professional and personal level, to make good in cleaning up the mess. A company, however, provides a much better level of protection for all the shareholders because the liability is maintained within the company, and the remaining shareholders are not actually expected to make good on the financial mess in cleaning it up. Imagine this: you and a select group of doctors decide to go into business together and set up a partnership. things run smoothly for several years, and other than a couple of gripes you have about the fact that you can't manage your tax and your cash flow properly, everything runs smoothly. Then something goes wrong and one of the partners is accused of doing something they shouldn't have been doing. Guilty or not, they are no longer able to be part of the business, so they are exited from the partnership. However, here's the sting in the tail. He's not the only one who pays financially for the wrongdoing. You all do. And for you, this means selling your family home and downsizing. If the business had been structured as a company, then most likely the liability would have been limited to him on his own, or the business and him on his own, and would not have affected the rest of you shareholders in a personal capacity. Most likely this would have meant you could carry on your life uninhibited. Shareholders in companies don't need to just be individuals, they can be trusts, partnerships, or other companies as well. In fact, pretty much any other business structure available in Australia can own shares in a company. From a wealth management perspective, this can be extremely attractive because it gives shareholders the ability to manage the income they derive from their shareholding and distribute it amongst the family group. Let's go back to our doctors in practice together. Once the partner has left the group, they seek some advice and they set up a new business, this time as a company. Because you haven't been able to properly manage your wealth in the past, this time you set up a trust and your trust holds your shares in the company. Each year when the dividends are paid, they are paid to the trust and the trust can then decide who receives the dividends. As a busy career man, you have been the breadwinner of your family for a number of years and your wife has earned significantly less than you. The trust is able to weight the distribution in favour of your wife so that we can better manage the overall income of the group and the tax liability on that income. So it would be remiss of me not to go any further without saying what exactly are dividends. Dividends are a distribution of the profit made by the company and they are entirely optional. You don't have to pay a dividend in a financial year. You can keep the cash in the business to use for other things like growth or acquisition. They are paid to shareholders equally in respect of their shareholding. So for example, if you have 100 shares owned equally amongst 4 different peoples, that is, they have 25% each, then when the profit is distributed as a dividend, you will all receive 25% of the profit or the amount that you elect to distribute as the profit. Dividends can either be franked or unfranked, that is, they come attached with franking credits, but this will depend on the performance of the company. A franking credit represents the tax already paid on a portion of the profit being distributed. So this concept of franking credits and how we treat them is unique to Australia. There is a recognition in the tax law that to tax profits and then the dividends again in the hands of the shareholders is to actually tax the same profit twice. So when the dividend, that is the profit, is paid to a shareholder, it comes with a franking credit, which is the portion of tax already paid on that profit. The shareholder then includes that franking credit in their tax return and is only liable for any top-up tax that's needed to be paid on that dividend. So how much tax is paid by a company? Well, this is another area that I love because it creates certainty. At present in Australia, if your company has a top-line turnover, that is gross revenue of 10 million or less, then your tax rate is going to be 25%. If your company is earning over 10 million in tax, or it is a passive investment company like a bucket company, which again is a topic for another day, then the tax rate is 30%. Profits are taxed just the once, and that is in the year in which they are derived. If you elect not to pay a dividend, but to rather keep that cash in the business to use for other things like acquisition or growth, then it is not taxed again because the tax is actually applied to the profit of the company and not the cash surplus in the company. The company, as with every other business, is able to pay salaries. If you are the working owner of a business, this affords us an opportunity to effectively manage your cash flow and hopefully remove almost entirely those pesky quarterly PAYG installments that you've been making. The company can pay you a salary. The company then manages the tax that needs to be paid on that salary, just as it does for other employees, or indeed if you were an employee of another company. It will also pay your superannuation for you. Because of this, your income becomes far more regular, meaning your household budget is much easier to maintain. You also don't need to be finding cash every quarter to pay your pay-as-you-go installments. At the end of the year, you can always take a bonus or pay yourself a franked dividend to reward yourself for the blood, sweat and tears you've exerted all year on your business. This can be really great as the business grows because it means you don't need to be drawing all the cash from the business and paying a really high marginal tax rate on it. As the business grows, it can remain privately held, which, as the wording suggests, means it doesn't have to report what it earns publicly, nor does it have to adhere to certain requirements or tell everybody what it's doing all the time. Alternatively, it can choose to list on the Australian Stock Exchange or the ASX. Generally speaking, companies who choose to list on the ASX are doing so because they need a heavy investment of some kind to be able to further a product or research in something. But here's the great thing about being a company. If you do choose to list on the ASX, you don't fundamentally have to change anything within the business to do so. Yes, there are certain things you need to adhere to, but you don't need to change the underlying structure of the business to list on the ASX. But there are some cons to having a company, and one of the big ones is not being able to access some of the capital gains tax concessions. So for individuals and trusts, the application of the CGT legislation is much the same. Both entities are able to access certain concessions such as the 50% discount. Companies, on the other hand, are unable to access any of these concessions, and as such, on the disposal of assets are required to pay capital gains tax on the full amount of the profit. Whilst this is a negative for a company, it does afford us some opportunities in terms of our structuring to help grow the business and actually manage your investments and your other assets effectively to help manage wealth. So, for example, imagine your business is a company, and in that company you own the building that you run your business out of. Due to some unforeseen circumstances, the business is forced to wind up and the creditors sell off all assets of the business to pay off its debts. This includes the building that you have been running the business out of. This then means, as the shareholder, that you're going to be lucky to walk away with absolutely nothing. Let's just imagine that the same business has the same assets, but this time it holds the building that the business is run from in a trust that is separate to the company structure. Let's just say that in the same scenario, something goes wrong in the company and it's forced to wind up. The creditors are called in and they sell off all the assets to satisfy the debts of the business. Because the building itself is held by a trust and that trust is separate to the company, they are unable to touch the building, and you walk away with something to be able to start again. Changing tack completely. Whilst the ability to distribute dividends is fabulous, the requirement to distribute them equally to all members of the same class can actually be quite a problem. Going back to our example of our 4 equal shareholders, each owning 25%, this means that when the dividends are paid, they all have to receive the same amount per share for their dividend. As a professional services firm, you might have different types of ownership structures, such as equity partners or salaried partners. Having all shareholders treated equally would mean that equity partners and salary partners are actually treated in exactly the same way and are expected to be given the exact same amount of the profit distribution, which isn't representative of their risk or tenure. All is not lost, and there are ways around this. Issuing a new class of shares to shareholders that would represent salaried partners is a way of making sure that one dividend can be paid to equity partners and another dividend can be paid to salaried partners. In time, as the model changes and people move around, you can actually swap out dividends from one class for dividends in another class to actually represent the movement of salaried partners to equity partners. Lastly, the reporting requirements for a company can be considered to be quite onerous. Although it must be said here that the reporting requirements for a privately held company are infinitely inferior to those of an ASX listed company. Annual reporting is required, together with all the usual annual compliance requirements. Minutes are required of meetings and to record any major decisions, acquisitions, changes to structure, everything. Documentation is required to be maintained around directors and shareholders, and it all needs to be reported to ASIC. An annual general meeting is also required between all the key decision makers of the business and shareholders to discuss the performance of the business in the last 12 months and make any decisions around what's going to be happening in the future. A good accountant will be able to navigate this pathway with you and make it so much easier. I personally don't consider the cons of a company to outweigh the pros. Accountants like myself who are passionate about playing with corporate structures to make it so that the best possible distribution of wealth and risk is managed in a business group will be able to help you change your structure or navigate your way through company ownership without it being too onerous or stressful. In fact, they should be able to manage it so well that you'll find yourself wondering why you hadn't switched earlier. On that note, thank you so much for watching. I will leave you with this video to watch next, and I will catch you in the next one.